trap. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the trap team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of trap.
Indeed. Welcome back, ladies and gentlemen, to episode 3 of the Real Advisor Podcast. TRAP, Trap. My name is Nick Lincoln. Joining me as ever in the studio are the 3 other horsemen of the apocalypse, Andy Hart, Alan Smith, and Carl Widger. Hi, guys. Nice to see you all. We live in hi, guys. We live in tumultuous times. As we're recording this morning, I believe the this month's Chancellor has reversed the not budget of a week or so ago. Disastrous. The markets are very scary, especially the fixed income side of things, bonds and so forth. And this will be impacting all of us and certainly our clients and their behaviours, which is why we're the Real Advisor Podcast, because we focus on what actually matters, the investors, not the investments. Carl, what's happening with you and how are you approaching the scary markets? Just talk us through your point of view on this.
Yeah, thanks, Nick. Look, behind me, we have our mantra, which has been our mantra since we set up Metas, which is stick with the plan. So, look, it's probably easy for us to, keep putting out this mantra, stick with the plan. But I don't think it's enough right now. I think there are certain times where we need to get out there and we need to, I suppose, give some comfort to our clients that, number one, it's okay to feel worried. Number 2, to reinforce and talk again about exactly why we set up our investments, our pensions, the way we did. And look, I think, and back to Alan's point at the previous episode, to maybe talk about investments a little bit more than we normally would. And I think that that's important right now. So what I'm doing and what we're doing here at Metas is throughout this year, actually, I've done a couple of videos which we've sent out directly to our client to our newsletter list and also our client list, just to talk about, look, we've been here before. This isn't new. It won't be different this time. And I use actually Andy's wall of worry chart. I think it's really good, and he's updated it as well, for this year. And I think it just goes to show that if you look to the long term all of the time, then that will give you some comfort that, yeah, we have been here before. It's not going to be different this time. But actually, what we've done as well is we've done 2 other things as well as the wall of worry. We're going to put up the dimensional chart whereby they show the world allocation funds and the various returns over 1, over 3, over 5, over 10, over 20 years. But also they show, what's the largest 1-year loss from a 60-40 fund or a 40-60 fund or whatever. And I think it's important, to show people that this has happened before and look what's happened since. And if you look at, what happens over when you look to a 10-year time horizon, that the results will kind of come through in the end. So really, I suppose what we're trying to do is we're trying to encourage people as much as we possibly can just to sit in their seat, do nothing, and just stay the course and stick with the plan, as we say. The other thing, we came across a really good chart, which we might put in the show notes, Nick, which is the average returns for the stock markets when, markets have declined by 20%, by 30%. And I'm just looking at the numbers here. The average return the year after 20% decline is 22%, and the average return the year after a 30% decline is 23.8%. So look, I think it's really important to be, giving people this kind of data, and for us, and I did say it last time, it's definitely getting a lot more into the nitty gritty of investments, of markets, of I suppose of giving people content to give them some comfort, and I think that's really, really important. But look, I just wanted to, I suppose, bring this point up this morning to acknowledge that it's scary, and it's scary for us too. And every morning I come in and I look at the assets under management, and it's just going one way at the moment. But to understand and appreciate it's a temporary market decline, and it's easy for us as professionals dealing with it. And I suppose within Metis, for me to talk to my teammates and we kind of reassure each other. But if we're feeling like that, well, what are they? What are the unprofessionals, so the people who are running their business, our clients, right? How are they feeling? And just to acknowledge that it's okay. But very, very interested to hear what you guys might be doing, and I'm sure all of our listeners and viewers will be interested to hear what other tactics can be employed to try and keep our clients, give them some comfort, but keep them in their seats so that they don't make that big mistake, which is basically bailing out when there are temporary market declines like this. Andy, what are your thoughts on this?
Well, yeah, this is very obviously current. Just looking at the numbers today, actually, we're looking at the September numbers. So the month of September, global equities were down 8.3%, just the month of September. US equities were down 9.3%. Obviously, they're the very unimportant numbers, but they're the numbers that our clients, are told, obviously, during these times, because they just report, obviously, the recent numbers. I think it's everything we do as client-focused financial advisors. It's not as if we're reacting to this stuff. We've got to live, sleep, and breathe this the moment we take the clients on. Tee them up for it during the good times and the bad times. But yeah, 2022 is certainly turning out to be an interesting year. It's great news, obviously, for our clients that are investing every single month. Again, they can't process this, they can't intellectualize this, but again, they're buying units, they're not buying stock market prices, but all they are told is the prices, that they never look at the units that they're buying. So it's good news for people that are investing every single month. I believe as a financial advisor, you need to be invested in the same portfolios you're telling your clients to stick with. I'm invested in my most highly volatile portfolio, the Maven Invest 100. I think it's an absolute, professional crime to not be invested in the same portfolios as your clients. And I believe you should be invested in the most volatile portfolio that your clients are invested in as well. So yeah, a couple of points there. I do share as much as I can with clients in terms of data and a few of the things that you mentioned, Carl. But it is about having grown-up conversations with clients. Fortunately, I haven't got any grenades that have been thrown into my business, which usually take the form of an email that's been sent on a cold Sunday evening from a client who just takes 1 second to press compose and then says something like, "Andy, I'm concerned about my portfolio. What are you doing about it?" Potentially, which is a huge yellow card in my business. So yeah, I suppose I've been educating clients, teaching them ever since I've taken them on. We tell them the numbers going in. The markets generally rise about 75% of the time and decline about 25% of the time. Every year, the market's going to go from a high point to a low point of, on average, about minus 14%. Every 3 to 5 years, expect at least double that. So yeah, that's it really. Back to you, Carl, or over to you, Nick.
Yeah, thanks for that, Andy. I suppose, look, just on one point that you made there, it's stick with the plan is our mantra, which is very similar to what you're saying. I do think, though, that we got to be cognizant of human beings and feelings and emotions, and it being okay to, if you've got a significant part of your wealth invested in a 60-40 portfolio and you're looking at, a pretty sizable euro or sterling, whatever it may be, drop, as in, that looks to the amateur investor, which all our clients are, like the money is gone. And I suppose, yes, of course, we have discussed at length at the outset and every other time we have the review meetings that, look, these are temporary market declines. I think it's okay for our clients to approach it like that. And therefore, we need to approach our clients a little bit differently and to, talk them through it and be very patient about it. Because I've found in the past, if you don't take a very empathetic view, you're going to find yourself in trouble and you might lose a little bit of trust with the clients. So I think you just got to be in massive listening mode right now and then have a couple of key messages that you want to deliver. Alan, what are your thoughts on this?
Yeah, all good points, guys. My thoughts are that what we don't want to do this time around, which we've done in the past, is bombard clients with stats and data and charts. They've kind of seen it all before, really. My view is what clients are looking for is empathy. And just to wrap up a couple of points that you guys have already said, it remains a fact that, I, and I'm sure you guys and my colleagues are all invested. We have our own family's wealth, liquid investments invested exactly the same way. I don't know how this is going to turn out. It's a very unpredictable market right now. As Nick has already alluded to, you've got politicians sort of making decisions, then you turning back and forward. So, we all know this stuff is unpredictable. So I think the message that we have actually given to clients is that we're not certain, we're unsure, we're exactly in the same boat as you are personally, but we've got you back. We're looking out for you. I think one of the biggest things, this goes into the deep behavioral stuff. Human beings don't like uncertainty. When there's things beyond our control, particularly things that we don't really understand. And this is what's made this current sort of period of volatility a bit different. They're always a bit different to the previous one. There's underlying things which are actually the same, but we know that stocks and shares, equities can go up and down and do go up and down quite regularly. But we had all felt that maybe having bonds in your portfolio was going to dampen down that volatility. Well, current crisis meant that it hasn't done. In fact, it's added to it. So we've certainly got clients who are at the sort of the lower end of the volatility. Which is good news for us
global equity super fans.
Right. Okay. And I think we're going to come on to that. One of the questions we've had coming in from a listener just mentions that. We'll come on to that in a moment. But
we have a listener.
Nevertheless,
we have a listener.
We've got one. I think we've got two. We've certainly got one. So it's those people who have said, I really don't like volatility, and this up 20%, down 20% stuff the stock market does, I want to avoid, I want to minimize that. So they've been whipsawed somewhat as well. So the thing that we've done pulling this together is I do like video as a medium. So we're able to do all these things, relatively simply nowadays. We've had my colleagues putting together very simple videos. Hi, we're here. A lot of uncertainty around. We're in the same boat as you are. We're paying attention to this 100% of the time. We've got you back. We'll get through this. This too shall pass. If you want to jump on a call, video call, want to meet me face to face anytime you want, I'm here. This is the time for advisors to be visible. This is the key point. 100%. So that's there is no answer to this. There's no answer to this. There's no I've got all the solutions, because no one has got the solutions. If someone tells you that, then run a mile away from them. But what people want is to know, all right, I know I can get on a call with you anytime I want. Me raising this as a question isn't a dumb thing to do. No, it's not. We all feel the same way. So having authentic empathy will make the difference right now. Get on the front foot, use video if you can, and say, if you'd like to have a meeting, you want to grab a cup of coffee and have a conversation, anytime you want, I'm here.
So, Nick, before I get your views, Alan, can I just ask you, can I just ask Alan, the videos that you're doing to clients, are you doing kind of a generic video and sending it to everybody? Are you doing very much client-specific one-on-one videos, or how are you doing it?
Yeah, good question. I've spoken in the past about making much more specific videos and doing kind of one-on-one in the interest, and that is an ideal thing to do. Go through it. In the interest of speed, what we've done is we've broken it. In the past, I've been the one who'd been in the front, kind of the voice or the face of the company, but we felt it's far better and more authentic to come from individual advisors. So my colleagues, who are the ones who really are, client facing, have the individual relationships with the clients, they're the ones who have created videos, and they've done them to all clients. They've sent them out to all clients. And it really is just putting your hand up, say, I'm here. And I think after that, we're also looking at where we've identified clients that are more concerned. As I mentioned before, those that have engaged with us more recently, that's ones where there's a big
first 12 months.
First 12, I would say first 36 months.
Talk about it a lot. Yeah.
Yeah, they're the ones that hang on a minute. I didn't realize this was going to go against me. That I've just hired you guys, and now I'm losing money.
I gave you X. Yeah. It's now worth Y. Yeah,
exactly.
Even though you told me, I wasn't really expecting it, and even though my risk profile questionnaire, which Nick
I know,
loves,
go down.
even though I said I was 5 out of 7,
yeah.
Whoa, really?
I've lost
Sure
X pounds.
Yeah.
No, it's like you've lost me X pounds. Yeah, so those
but
are
that's
the
buyer
ones.
remorse, isn't it? That's
exactly. They feel like they've made a mistake.
Really
confirm they've made a mistake. Yeah.
It is, and I don't think there's much you can do about that, because I often talked about the.
But this is why the welcome
life.
meeting
Hang on a sec. Just having
episode is so important. I'm going to continue talking over you. Did you wear the jump when you did the video?
No, I didn't do the video.
Anyway, moving swiftly along. Nick Lincoln, can I ask you? I think I might know the answer to this question, but are you doing anything specific for your clients, or how are you dealing with the most recent temporary market declines?
Yeah, I'm on the cusp of thinking I should be doing something. This is so different from 2 years ago when we had the Wuhan crisis, and markets, equity markets fell off a cliff, didn't they, in a month by a record amount. And then I think all of us were we were all doing videos or newsletters, not the kind of thing we normally do, because we don't want to give our clients extra cause for concern. So we make our communications, when we do them, very prescient and on point. And when that happened 2 years ago, 2.5 years ago, we were doing it. I haven't done it for this one. A couple of reasons, really. The fact that sterling and the euro has devalued so much against the dollar, which is still the world's currency reserve, means actually the equity market falls have been kind of offset. What's different this time is that its bond markets have really had a pummeling. And no matter what we think about bonds, and I'll come on to that in a second, they dominate in terms of their influence. If equity markets fall, yes, it's unpleasant. But when bond markets fall, it has ramifications right through the system, through the banking system, through pension fund liabilities, to interest rate setting and everything else. And of course, bonds have absolutely fallen off a cliff. As I'm sure with you guys, most of my clients don't have great exposure to bonds anyway. So thankfully, they've been inured to that in terms of their portfolio having any problems. But there are horror stories out there. And I'm talking soon. I'm going to South Africa with Andy for his Humans Under Management in Cape Town in next week, actually. And I'm talking about this as being the chance for us to finally cleanse ourselves of bonds in client portfolios. They were there for one reason, to dampen volatility. Turns out they couldn't even do that. I think there's going to be massive ramifications for the attitude to risk industry that has made a fortune over the past 20 years or so, putting people into totally inappropriate portfolios. They've been found wanting. And this is an extreme example, and it's not the kind of bonds that we would put our clients into, which would typically be shorter duration, which are more limited on the downside. The ticker for it is Tango Golf 73. This is a UK index-linked gilt. Now, index-linked gilts are different from your average, and no one really understands how their prices work. I don't. There are so many, in an index-linked gilt, there are so many moving parts. This is a long-dated index-linked gilt. When I say long-dated, its redemption date is, I think, March 2073. So it's right out there. In 2 days, last week, this safe, in quotes, government gilt fell by 59%. That's the kind of volatility that if that was Cathy Wood's ARC fund, we'd be saying, well, that's even for her, that's a bad day at the office. It's all nuts.
Am I right in saying, Nick, that it was down 59%, but that consisted of down 80% and then kind of back up 20% over 2 days? I think, was that the kind of volatility?
One day it's down 49%, and then it or 44%, and then lost another 15% the next day.
Okay.
Anyway, over 2 days, its unit price fell by, not unit price, its sale price, if you went to a broker, fell by 59%, and that's a gilt. Okay, long dated. Okay, index linked, but and that's what's different from 2008-9 and from the two and a half years ago. Is this just collapse in bond prices, which are really they ripple out. That kind of thing ripples out through the financial markets.
So is that what you're saying is that normally you wouldn't necessarily go out to your clients with something specific, but you feel that this is a little bit different this time, so that maybe it's justifiable at this stage?
Well, no, I'm not just saying that. You're right. I wouldn't normally go out to my clients, but I do when their equity portfolios collapse or temporarily decline, rather, because that's what most of my clients, that's what I'm in. As Andy said, I take exactly the same medicine as I prescribe. I'm in exactly the same portfolio as my clients are. And to hammer home Andy's point, advisors who recommend something for themselves and something different for their clients are the spawn of Satan, and that's a technical definition. So when the equity markets plummet, I'm on the
Agreed.
front foot. As I say, most of my clients don't have their big exposure to bonds really. So I haven't yet reached out. God, I've said it. Sorry. Yeah.
Well, but one of the issues is translating media and news reports, because all of the news recently was, pension funds are in trouble. Now, the average client doesn't know that
what does
doesn't
that mean?
Their pension fund. They think, well, my pension fund, which is probably a normal money purchase, self-invested personal pension or something like that. Yeah. Oh, does that mean my pension is going to get hit? As opposed to it's really focusing on institutional defined benefit schemes, which are coming under pressure. So just being on the front foot with that and articulating and explaining, although it says pension funds generically, it's unlikely to be your own pension fund. But that leads me to the other thing around the media communication. By its very nature, markets and media are super, super short term. They're talking in terms of hours, days, weeks. Whereas this is a disconnect, because we're all kind of reporting and operating in a financial services world. But our mode of operating is multi-decade. We're speaking to our clients for tens and tens of years, and potentially more if you're talking about intergenerational wealth and passing wealth down. So all this stuff, eventually it all settles down, doesn't it? If you're talking a 30-year time horizon, bond markets settle down, equity markets, things tend to behave in fairly predictable ways over multi-decade time periods. And what we've got to deal with the communications over literally hour by hour, day by day type communications, and sort of just bridging that gap, I think, is a challenge for us. Just to remind clients, yes, it's crazy, yes, it's up and down all over the place, but we were never investing for a week or a month.
Yeah, and I think the proof in that, Alan, may be that we're recording this on the 3rd of October, and it won't be out for, I don't know, a couple of weeks. a lot of what we're discussing now may well be out of date by the time this comes out, which just goes to show how quickly things can move. So, I think it's mostly just to be out there and to make sure your clients know that you're available. Sorry, Andy.
A couple of other data points. I mean, we moved into a bear market, I think, in July 2022. I think the market was down. The S&P 500, if we're using that as a proxy, I think it was down about 24%. I think now in October, it just sort of breached about 26%. So the new lows have been found sort of 3 months later, which is unusual or not, until you see it. It's quite rare until you see it. The other thing as well, we've got globally well-diversified portfolios. So they're not, they're about 50% in the US, and they've got a chunk in Europe, then Far East, etc. So I think my most volatile 100% global equity portfolio is only down by about sort of minus 12 or something like that, which in the grand scheme of things is not much. But, depending on what headlines they see, depends on how they're going to react. So yeah, just a couple of other sort of data points there.
I mean, I'll just to bring home some sort of real life how a client's reacting, how my client's reacting to this. I've got this habit now, which I think is a good habit. On a Friday night, I turn off incoming emails to my work email account. Okay, I kind of snooze it because I just don't want that headspace of reading an email on a Saturday afternoon or something. Or likewise on a Sunday. And then on Sunday nights, I turn it back on and the emails come in. And I had eight emails come in over the weekend. Most of them were DocuSign, people signing DocuSign stuff. It's all that kind of stuff. There wasn't a single one. And I thought this is going to be a weekend where I'm going to get one or two clients saying, I've read something in the Sunday Times comic supplement, the money section. I'm spooked. And there was nothing. But maybe that's because I haven't got an enormous client bank. It's
I was just going to say, once you get beyond kind of 10 clients, it's probably going to start hitting.
Well, I'm 8 away, Carl.
This is going to be a barrage. I don't think the bad news has really started yet. I mean, this contagion effect is going to be, again, I don't want to make any predictions. I think this is my third crisis I'm going into it. The great financial crisis, I was a little bit fresh into this business. COVID, I was very much involved in on the front foot. Both from the sort of health standpoint, obviously everyone was going through it, but also financially with all my clients. This one, I'm going into this, eyes wide open and somewhat experienced. But I think there's a lot of bad news to come down the track. But then how will that, obviously the market's usually ahead of the economy. We all know that. But again, we're going to get this horrendous, economic news. And at the same time, so has the market recovered? Again, we just don't know. So yeah, I think there's some pretty bad financial news to come down the track.
Yeah, and I do think you guys are getting it kind of worse, because obviously the UK has its own very specific problems, of which I'm au fait with some and not with others, other than it looks like a total another shit show over there. And yeah, okay, as your closest neighbours, we are kind of interested as to what's going on, but at the same time, you know, an answer to a question from a client of ours would be exactly the point that Alan and Andy made. You're in a globally diversified portfolio. The UK makes up about 4% of that. So, you know, whilst, yeah, we'll be keeping an eye, it's not the be all and end all.
Isn't it?
And on that point, like, what is going on over there, boys? Can you summarize it in 1 minute?
Do you know what? I don't want to be ranty. I thought last week, you know what? Maybe we've actually got a tax reducing, capitalist focused, real growth funded by commerce and businesses, as opposed to funding by borrowing by governments with the tax. And now it defies belief that we spent £370 billion on lockdown in total, including furloughs and everything else, 370 billion. And the Chancellor fiddled around with the top rate of tax and brought it down to the same rate it was under the last Labour government, down to 40%. That costs $2 billion. And this government has just backed down in the face of criticism. The message it sends out is absolutely the turmoil in the bond market. It's nothing to do with that 45% tax fiddling. The $2 billion is neither here nor there for the government. The bond markets are spooked by inflation. They're spooked by the energy subsidy that was also given away in that budget. Far bigger, and the government should have said that. I am just beyond. I cannot believe what they've done. Already, she has lost her credibility. She being the Prime Minister, Liz Truss. Already, Kwarteng has lost his credibility. I don't know what. But what do you do? What's the alternative? You know, is it the least worst? I don't know. Alan, what do you think?
I try to stay out of politics. It's very difficult, but you're right, Nick. I was broadly in favour of this, the kind of austerity style of higher taxes that had been adopted by the government for the last however many dozen years or so. Certainly didn't seem to be working. So let's get enterprise, let's get business, let's make things more productive. We can sort of use that as a method of improving the economy. It seemed like it was a step in the right direction, I felt. And you're right, Nick. It's just, oh God, there's a bit of pushback, a bit of negativity. So all right, we'll change it, and only change one thing. And as you say, of all the things, it was kind of neither here nor there, really. So it's disappointing. It shows you, though, that we are in a kind of personality politics environment where tough economic decisions are being watered down because people want to stay in power. We're only 2 and a bit years away from another general election, so people are thinking ahead to that. We've got a brand new Prime Minister. And so people are making decisions to keep, maintain popularity. I don't think it's done it. They've lost credibility. So, yeah, it's disappointing. I'm just of the mind that it's one of those things, control the things you can control, focus on those, and let go of the rest. So it's all a lot of nonsense, really. What I can control as best I can is the way we operate as a business, the way we communicate with our clients, the way we engage, the way we support them, the way that our team operates. And just focus on that. Like I think all business owners are trying to do, whether working in financial services or not. Focus on the matter in hand where you can influence and make decisions. The politicians are always going to be politicians, unfortunately. And they've got a different agenda and different time horizon to us. So I'm just getting on with things. I do have one thing to throw into the mix here in terms of client communications and how you position. All you guys will be familiar with a statement or a sort of a summary offering from Nick Murray. Nick Murray being the kind of financial advisor's advisor. He's got something that...
Grab yourself a drink, a very long drink. It's story time with Alan Smith.
Finally, you played it.
Oh, dear listener, if you're not watching this on YouTube, Alan just gave me a very approving hand signal when I played that. Sorry, Alan, crack on.
It was a V for victory, wasn't it? This is a very short. It's a very, very short story because I'm just steering people in the direction of finding something for themselves. But Nick Murray referred to something called a cup of coffee and a second opinion, and it's sort of brought out every now and again when you just want to put yourself forward. It can be used to sort of generate opportunities with other clients who are not being communicated to by their current advisors. You could just, I'm not going to read it out, but you could just Google it. A cup of coffee.
Imagine being a client of these investment advisors that have just pitched themselves as beating the markets, never having declines. They'd just be spinning around every single second of these last few weeks. It would just be the most hideous way to survive.
It's
and
a
make
tough
a living.
gig to defend, isn't it? It's a tough gig to defend because not only are you down, but you're down more than the actual prevailing markets are as well, which is in most instances they are. But I think it's a nice wording. I think there's a nice language that sits behind. You could just Google it, a cup of coffee and a second opinion. You post that out to your contacts, connections, and so on. That's all you're doing. You say, look, I don't know. These are the wording is along the lines of these are scary times, but we've been here before. We've got years or decades of experience. Don't know really necessarily what the answers are, but if you want to sit down, have a quiet conversation, cup of coffee, either way, the coffee's on us. It's a nicely worded narrative that people can send out to their clients.
The £5.50 cup of coffee's on us.
Exactly right.
Exactly. And it is about £5.50. I went to, what was it, Costa Coffee in Watford at the weekend. Blimey. And just to
living a dream, Nick, living a dream.
I tell you what,
pushing the boat
Costa Coffee at Watford.
I was dragged round the shopping centre by the lovely Penelope, and then we went for a coffee, and it was okay. It was one of the highlights of my weekend. Just maybe wrapping a bow on this because we're already 31 minutes in. The one thing I think is going to for all of us, because we all do cash flow planning without exception for all our clients because we're real financial advisors. I've already had a couple of clients saying, looking forward to my next meeting. Can we look at interest rate rises, mortgage rate? Because although, Alan, you're right, it's a 30-year cycle. Yeah, it's a 30-year cycle. But the fact is people are coming out of their fixed rate mortgages at like 1%, and they could be going to a variable or a fixed rate of 4 or 5% if it's happening in the next week or so, or next month. So that's come back into the mix, which is something we haven't had to deal with as financial planners.
Rate rises.
They're
going to be serious.
Can I make a point of that, Nick? We had a chat here in Metis about that only last week or maybe the week before, but a lot of people were still carrying some debt, some mortgages, because they were on tracker rates and the rates were pretty much zero, and it made sense to do that and run your investment alongside it. And we just had a chat here that, look, when we're doing reviews, maybe we should start talking to people about, let's go and clear the debt. And actually a little bit stronger than that, just talk to people about, look, now is the time, let's maybe take some of the investment money or liquid cash and dispose of the debt that I'm a little bit distracted here because my friend Alan Smith is coming in twice across the bottom of my screen, but I don't know what's happened. But anyway,
just on that, Carl, what the interest rates in Ireland? What were they? What are they sort of at the moment? What are they projected to go to? Is it similar to what's happening in the UK?
Yeah, it's almost identical. So we're looking at 4.5, 5.5 at the moment, and that's up from very low rates of under 3 for variable rates. So it's more people who were on trackers, so had the ECB rate plus a margin of 0.5 or 1% or whatever. Obviously, that's just going up and up and up, and the projected amount of increases over the next kind of 6 months mean that it probably no longer makes sense to be carrying it if you also have liquid cash. But I suppose cash flow modeling, that will make sure that you can run these scenarios and say, look, all other things being equal, I think you should probably get rid of that debt now at this stage.
Certainly mortgage conversations are a lot more front of mind now with clients. And it's good that if you as a financial advisor sort of understand the mortgage market. I fortunately am an ex-mortgage broker, so I know it very well. So I have lots of conversation with my clients about mortgages. I think it's a bit of a hole. A lot of advisors are a bit too evangelical that they don't sort of know the mortgage market too well. I think it's a bit of a hole in their arsenal, to be totally honest.
Nothing worse than having a hole in your arsenal. I think we're probably doing this one to death now. If it's okay with you, gents, should we move on to answering a couple of questions from our Trappists, our beloved audience? Let's do that.
Yeah, let's do it.
So we've got a question posted via Twitter from James Marston, and he's on Twitter at James Marston 88. I'll read the question out, and then one of you maybe who picked up on this question can answer it. Does the recent collapse in bonds invalidate the whole risk profiling process? And given that bonds clearly have as much downside as stocks in certain scenarios, aren't we all better off being in 100% global equity ETF? So who posted that question in there?
I did. I got the message from James about that. He had just been asking me via sort of messages on Twitter. And so James, as I understand it, is a relatively new advisor, and of course he's been given the Kool-Aid to drink. This is what you do here. You do a risk profiler questionnaire, and if a client says I'm low volatility, then you give them a load of bonds in your investment. And he's obviously being somewhat disillusioned by having done that, found that he's encountered tons of volatility and said, well, we know that long-term global equities is the place to be. And so why don't we just invest in that 100%? Which, we want to have some controversy. We want to have some good quality debate on this, but I think something we all agree with.
Well, I think we do. I think outside of our circle and maybe the Spartans that we mix with, what we're about to say and what you just said is going to give a lot of advisors willies, because they love their asset allocation and they love their fixed interest exposure because of modern portfolio theory, stuff that I think over the last 15 years we've realised that bonds are rubbish for income. They don't do anything for income. And now we're actually seeing they don't do anything to dampen portfolio volatility. So you have to ask the question, what is the point of them? What is the point of attitude to risk questionnaires? I think this is the great reset for bonds. This is our chance to get rid of this cancer out of our clients' lives. And I feel quite strongly about this, as you'll find out when I talk about it.
Say what you think, mate. Say what you think.
This is our chance. This is our real chance.
Is it fair to say that this current crisis is the first time I can remember where you've had a significant correction, bear market in equities and long dated bonds, particularly at the same time? I mean, the great financial crisis.
Worse.
Yeah, I know. But so in 2007-8, if you invested in long government bonds, you were in positive territory. I think you're up 7%.
Yeah, you did all right.
Yeah, you were.
You're right in that period. So that was one where the so-called, the asset allocation thing. If you wanted to dampen volatility, that was fine. You did get you did achieve that. Now right. You haven't had it.
You're right, Alan. Certainly it's not happened in the last 25 years. I don't know it well enough to even go back further than that, but there might be a case of it's never, ever happened.
It has happened.
So that's why.
1994, global equities lost value in that year, and the fixed income markets, global government bonds around the world fell in value.
Okay, so
and I remember
28
it's so
years
unusual.
Ago.
It's so I know it's
28 years ago.
That's how
so you're about 45 then, weren't you, Nick?
In Earth years, I was 45. Yeah.
So, but is that maybe the answer if you're being contentious or you're defending, asset modeling and risk profiling? Say it is a once in a quarter of a century or more situation, and you can't mitigate for those things in relatively normal market times. I mean, relatively normal is a global financial crisis, 2008. They held up well. I can't remember what happened in COVID times. I think bonds must have held up pretty well as well when the markets collapsed. Well, when equity markets collapse. So generally speaking, they do. And this is you have to be clear as well about the particular type of bonds, because I know in 2007 people were investing in corporate bonds, which collapsed as far and fast as equities did. But government sovereign debt with countries like UK, US, and so on tend to be a safe haven asset. So they tend to be very.
There are 2 points here. I hear what you're saying, but we've had bonds in portfolios as this dampener. But why? Because there's this dragon that we're slaying that doesn't exist. Earlier on now, you mentioned that we're looking at 30-year plans, multi-generational plans that will span decades. It's impossible to lose money historically over any rolling 20-year period in the MSCI World Index. You cannot lose money.
Of course,
What role do the bonds have in the first place?
This is a sop to.
It's a sop
to human behavioral psychology, because we know there are certain people that say, if my investments fall, I know, Nick, I'm investing for 20 or 30 years, but if I wake up one day and my £100,000 is worth 80,000 or my million's worth 800, I won't be able to sleep at night. So that's why, and yes, it's an education process, but I think as we've all identified, you can have these conversations with the clients. One of the biggest failings in my mind for risk profiling is it asks you a question at a time when you're in a place of, if you like, calm discussions. How would you feel if such and such and such? But what always happens when you have significant market volatility? There's loads of other things going on in the world. So COVID was, you might bloody die and your family might die. So you're not really And right now, your mortgage rate's gone through the roof. You might lose your job. Your family might lose their. So there's a lot of other things which makes risk profiling in itself questionable. I've talked in the past. If I said to any of you, are you scared of snakes? You might say, not really. If I literally throw a live snake on your lap, trust me, you're going to recoil. You're going to stand up or do something. But you told me you're not scared of them. So risk profilings are somewhat artificial in the way that they are presented and the time they're presented, because you don't know how you're going to feel, because there's probably a lot of other things going on. So I do hope that this is an opportunity, the current situation is an opportunity for that entire kind of sector and industry to reappraise, rethink, or good quality advisors to rethink how they use these sort of tools, as opposed to just being a tick box exercise for the compliance people.
Andy.
Well, yeah. We've been questioning them for years. I think the good thing about a potential crisis that we're going into, the principles and the essence of what we've been preaching to clients never changed. And this is through the good times and the bad times. Try and control your expenses as best you can. The markets will be volatile. Ideally, invest every single month. Focus on the units, not the prices. So that's the good thing. We're not always reacting to, the new environment. Over to you, Carl.
Yeah, I think, like Nick, I love the mumbo jumbo questionnaires. Isn't that what you call the risk profilers? Yeah, look, I get all of that, guys. But at the same time, from a compliance point of view and a regulatory point of view, we need to make sure that we are fulfilling our obligations. So asking advisors to solve the problem, I'm not sure that we can actually solve the problem, or it should be up to us to solve the problem. Maybe it's our regulators should be solving.
The regulators not done anything. The academics have not done anything. I call them misconception mirrors. That they're absolutely atrocious. I mean, Jesus Christ. I mean, I've got my own. I've got an investor profile. I think it's the best on the market. One of our famous friends has stolen it basically word for word, so I think it is the best on the market. So I gave it a good crack, and I'm still struggling with it. But you're right. We've got a compliance regulatory obligation, and it is a bit of a process with clients. But then again, they've got us in their corner, and we're going to be holding their hands. We're going to be, on the phone, on email, etc. But yeah, it's still Andy, a challenge.
To answer James's question, which was in the end, aren't we all better off just being invested 100% global equities?
Yeah, from a financial point of view, he's correct. From an emotional point of view, regulatory compliance point of view, that's something else that we need to consider. But I'm an insider. I'm 100% invested in 100% global equities 100% of the time, and I'm an insider. Follow what the insiders do. Chemists, pharmacists, they take generic drugs. That's the correct answer. The correct answer in investing is be invested in 100% global equities 100% of the time. And that's it. I'm an insider. But then we have to pander to non-professionals, non-insiders who are our clients. And we want the best portfolio is the portfolio you stick to. That's it. The best portfolio is the portfolio you stick to. So we just got to work out what portfolio you're going to stick to. 2 new clients I've taken on long-term. Sorry. Oh, is that my first clap?
Well done.
And just probably your last.
I've just taken
you're on fire,
on
Andy. You're on fire.
I've just taken on some new clients, Mr. and Mrs.
Oh, well done. Another round of applause, please. 2 new clients. You're catching up with Nick.
I was just going to say, he's now got 9.
They both filled in my investor profile. Mr. is a long-time podcast listener, so he's well versed with global equities and being calm through all market cycles. In the end, we've ended up with Mr. being invested in the Maven Invest 100 and Mrs. being invested in the Maven Invest 80. I'm just, as I say, the best portfolio is the one that they stick to. He'll stick to the 100% global equity portfolio, and he'll love it during the declines because he's buying more units. And she'll hopefully stick to the Maven Invest 80 portfolio. So that's that.
Okay. I think we've probably covered that off as best we can. There is no obvious answer to it, but I think we've debated it, and I think it seems that this is something which is evolving, and certainly perhaps more people will question just getting a standard risk profile questionnaire and delivering a portfolio, which is exactly what it tells you.
The answer is certainly not giving an investing illiterate, who are most of the people that come to us, who's 62, a 25 question survey that in some ways fills them with financial anxiety already, and we told them we're going to remove that, and then it pops up that they should be in a 60% bond portfolio for the next 40 years. That is certainly not the answer. As I say, I don't.
Agree.
Yeah. Okay.
And
Enough
I think,
about that.
Let's just finish. But waiting for regulators or compliance to lead to successful client outcomes, I think you've got a long way, and we've just got to be as brave as we can be without transgressing.
Yes.
We've got to be as brave as we can be.
Exactly.
Okay.
Yes, the point.
The next one, second question from our beloved Trappists. This is from Joshua Carr, who's on Twitter as @Joshua Bromilo. Was there a moment in your career when everything clicked and your role in your clients' lives became clearer? I would like a first dib at answering that. I'll a very succinct answer, and then I guess it might be Alan again to run with that. So I think you put it into our script here. Yeah, there was a moment actually, and I've spoken about this, and I think many people have gone down this same road, and it was the time when I discovered, via a man who is very much Marmite, Mr. Paul Armisen, but I went to this thing in 2008. I went to this presentation, and he showed me how he does proper financial planning using cash flow modeling software. I didn't know what proper financial planning was. I didn't know what cash flow modeling software was walking into this event. I walked out and it blew away it just blew me away. And that was when I thought, you know what, this is my role for clients. This is that guiding them to the financial security, taking them away from the darkness, from the wilderness that's coming to them. This is what I need to do. And it was that moment, and it just changed and off that cascades so much else. You suddenly realize that investing and investments and picking funds, not important, dull. You realize that people just want to be having a damn good listening to, and that most people who come to you with concerns about pensions are actually saying, Nick, are we going to be okay? And it just transformed everything. And that was 2008. And I built my business on the back of that meeting with Paul Armisen. And for whatever else we think of the guy, that is to his eternal credit. And there are many good advisors in the UK doing proper financial planning who wouldn't be doing it for Paul Armisen. So that's my.
I was at the same presentation in St Albans. I was blown away that these people in the room were not doing what he was showing already. I couldn't believe the low level of what financial advice was in the UK when I came into the business. You mentioned about investments, Nick. I'm going to push back on that. It is very important, but very easy, if that makes sense. You said it's not important, picking investments and stuff. I know you know how important it is. We are going to give our clients a great portfolio. It's going to give great returns, but it's certainly not the central thing that we're doing. I mean, it's easy to just set it up and get them in the right portfolio, early on. So I'd say it is important, but it's quite easy. Anyway, push back on that.
Good point, Andy. We'll come back to you as you answer the question of what was the career-defining moment for you. But just to be easy, I'll just jump in your slipstream, Nick, because mine's the same. It's my own version of that. And it is with the same guy, Paul Armisen. I think mine must have been a year or two before you. And the reason why, and I spoke about this, we don't have time to go into this in great detail, but I sat in that room, it was actually in London, where Paul presented. And it was like the biggest light bulb moment going off. I thought, wow, hallelujah. I finally can put everything into context. But what I thought actually was about myself.
What were you guys doing before? Just telling clients I'm going to help you with your future?
We were not doing it.
We were finding the best pensions, best investments for clients.
Mate, surely you were selling
mortgages with a shiny suit on. Don't criticize. Listen, there's still plenty. There's a big part of the community. The market still sells funds and policies and portfolios and so on. But I thought that I had a kind of revelation in my own life. Paul tells, and if you've read his book, he tells some very deep and personal stories about, losing his mum when he was quite young, and all this kind of, we put off things for later, wait till this happens, wait till that happens. And I actually spoke about this. If it's still available, I think you can still get this at Paul Armsen's first conference. Start with why?
Back to why.
Back to why. And I spoke about this, my sort of moment of the penny dropping, and it had a big impact on me because as a result of that, and I thought about my own life, I ended up getting married. I ended up having a kid also because I just thought, this puts everything in perspective. What are you doing with your life? Why do you keep kicking things down the road and wait till something gets better? Take action on it now. So I just thought at that moment, I'm going to sort out my own sort of situation, and then I'm going to get this software into the business, and we've been using it ever since, and it really was a game changer. So Paul's been hugely influential, has to be said. Over to you, Andy. What was getting back to the question, was there a moment in your career when everything clicked and your role in clients' lives became clearer?
I don't think there was. I can't isolate one moment. Me finding Voyant financial planning software was, in terms of the plumbing of this whole business, that was a key moment. From that, I was exposed to lots and different advisors. So that's where I somewhat have a unique position, where I've traveled the whole country and gone into firms and learned loads of stuff from loads of people. There's a few key advisors I've met along the way. Alan, you're definitely not in the top 3 of those people. I joke. When do we have a coffee? About 11 years ago or something on Marylebone High Street.
Who paid for the coffee?
Yeah, me.
Was it less than £5.50?
Anyway, we'll move on from that. For me, it's finding Nick Murray. So he was introduced to me by another financial advisor, and that completely changed my entire life and world, to be totally honest. And that spawned lots of other things. So he is definitely the biggest influence on my career. Over to you, Carl.
Yeah, mine is I told the story at Hummed Up back in 2018. We had set up Metis to I won't give you any V signs. We had set up Metis to do real financial planning. And I'll cut a very long story short. Basically, we had a chartered accountant who had left practice to go into industry, had done very, very well, was married to a nurse. And the chartered accountant was telling his nurse wife, who he loved dearly, that she could give up nursing, and she didn't believe him. And we did the financial plan. We showed them the Voyant stuff. And she got emotional. She was like, for the first time, could see right in front of her eyes in pictures that they were going to be okay. And she leaned across the table and said, can you promise me that we're going to be okay if I give up? And I went, yes. And she got emotional. And I can tell you, I got a little bit emotional. And so did the chartered accountant. And for me, we had been doing it a while at that stage, but that was the first time I went, yeah, we're actually having a real impact here. This is real stuff. So that was my moment, and that kind of gave me the impetus to drive this business on and to try and I suppose expand it and scale it to where we are today.
Okay, wow, some powerful stuff there. So I hope James and Joshua, you got some value for that. And ladies and gents, any questions, please do post them. Follow us on Twitter @Advisor Podcast. You'll find a pinned tweet at the top of our Twitter account where you can leave comments and or just leave your question in a Google form. So we don't miss it. If you put it in the conversation, there's a good chance that one of us 4 idiots might miss it. I think it's time for us to move on to Culture Corner. And looking at Culture Corner, I'm going to go first very quickly. And I'm going to talk about something that's a bit in the weeds. And you might think, well, Nick, that's of interest to you because you're a podcaster kind of person. But my gadget is what I'm talking to today, which is a Samsung Go Track Pro mic. And the reason why I think the audience might want to know about this is that we're all now doing way more Zoom than we were before. And some of us are doing nearly all of our client-facing work through the medium of Zoom. So you want to give the very best presentation of yourself as you can do all the time, because perception is reality. And if you've got a crappy sounding microphone and a crappy sounding camera, it's a pretty crappy experience. And we don't, we're in the service business ultimately. So I bought this mic. It's lovely. Why is it better than anything else? Well, it's got the mute button on it, so I can press that without having to fiddle around with my computer settings. It's got a level thing, so I can adjust the level of the microphone again without having to fiddle around with my computer settings. And it weighs 1.6 kilograms. It's built like an absolute brick, house. And I love it. You can get it. They retail for about 150 on Amazon, but you can get this. There's an eBay source knocking them out for 99 quid. And so far, I'm very much in love with it. Alan Smith, Scandal, bringing down Wirecard on Netflix. Tell us, Mr. Smith.
Yeah, there was just something I watched over the weekend. This is available on Netflix. It's a sort of film documentary about, you'll remember a couple of years ago, a German company called Wirecard. And there was this whole kind of deep investigative journalism process that went through a young Financial Times journalist by the name of Dan McCrum. And it really, you watch it, it's like a bloody spy movie and a sort of espionage thing. You wouldn't believe that there's Russians involved. There's all sorts of shady characters. In fact, one of them, who was the chief operations officer of Wirecard, has just disappeared. He's flown to wherever, destination unknown, and continues to be out with the grasp of the regulators and the authorities, because it was this huge scandal and a fraud, and a company that was, that it was supposed to be the darling of the German economy, fated by the Chancellor of Germany, all the politicians. It was going to compete with all the sort of US Silicon Valley companies. It was like sort of a PayPal, payment processing type company. But once this journalist started digging in, he's finding more and more irregularities. There was death threats against him and his family. There was people following him for a period of time. He was sort of suspended by the FT for a period of time. It really is. It's like a story that you couldn't imagine was, as they say, truth is stranger than fiction. It's well worth watching just because it's fun and interesting and really engaging. I remember reading the newspaper reports. It was only a couple of years ago. And I think the moral of the story here is that linking it back to investment is that diversification is your friend, because no doubt most of our clients were invested in Wirecard for a period of time as one of the sort of biggest companies in the German economy. They would have been. But the fact that they went out of business due to fraud probably didn't make much difference to overall client investment returns, because it would have been a very small part. But no, highly entertaining, worth watching. And, hats off to Dan McCrum, the FT journalist, who did a sterling job.
Excellent. Thank you very much. And Carl, you have a episode 300 of the Michael Kitces podcast featuring Mr. Joe Duran. I think Alan and myself might just quickly comment on this as well, but go, sir.
Get the knives ready. So the name of the podcast was The Evolution of the Advice Business at Scale and the True Power of Brand. And these are things that are very interesting to me. And I'm always wanting to try and learn from people, especially who've been there and done that. And I know that we would discuss amongst ourselves, taking advice from people who haven't actually done it. Joe Duran, whatever you guys might want to say about Joe, he's done it twice. And he is very interesting. And I think United Capital, which was his business before he sold to Goldman Sachs, was superb. And I read up and listened to as much as I possibly could. So a lot of Metas is based around some of the stuff that I would have learned from him, amongst lots of other people. Obviously, there are things that he says that I don't agree with. But I think the point, before you guys have your say on this, I think the point on this is that, number one, if you're into real financial planning, I think the Michael Kitces podcast is a really good one to be following, among some other really good ones from America. And number two, you should be taking as much inspiration as you possibly can from people who've been there and done that, and from things or values that they have promoted that you can also align your own values to. So I think that's important. I found it really good. Probably not as good as some of the other podcasts that Joe has done, but I guess he's a little bit handcuffed now that he's under the Goldman Sachs brand. It's worth listening to if scaling a financial planning business and growing a financial planning brand is on your radar.
Don't listen to it, Nick.
He already has.
Too late. Alan, your very brief feedback on that particular episode.
I know it's sacrilege to say anything negative about Joe Duran, because you're right, he's a legend. And what he's done, I was a huge admirer of United Capital. It felt to me that he's really been bitten by the Goldman's bug.
Yeah.
And it was all about, how can we squeeze an extra dollar out of our clients? And he constantly was talking about this, what are you going to do for your 1%, And 1% doesn't have to be the way you charge your clients. And certain clients beneath certain wealth levels were uneconomical. And he was talking about using technology to get the number of clients that any individual advisor can look after up to 250 or 300. And Kitches sort of tried to, he pushed back on that. He sort of unpacked it. So, there's only, there's 2,000 hours in the year. And Joe Duran came up with, you need 5 minutes preparation for a client meeting. All you guys, he seemed very, very down on and negative about, independent advisors, the smaller boutique style firms all of us represent. Very negative. And I just thought, come on, that's what you were. That's what you built. He built United Capital through a significant acquisition model. He bought lots of other firms and then he rolled that into Goldman's. And it just felt to me he was a bit more negative than he perhaps should have been, biting the hand that feeds, because he's now part of this huge kind of global investment bank machine. And I think Kitchens did push back on him. And you're right when you say, Carl, there's lots to be learned from Joe Duran. I would go back to episode, whatever it was,
100.
Was it 200 or 100? It was
100.
100, the 100th episode when he was at United Capital. Because I remember that one. I listened to that all those, a few years ago. Tons of good ideas, but still stand the test of time today. I just didn't love what he was saying about the kind of the advisory model, the independent advisory model, and how he's pushing forward and coming up with ideas how you can squeeze more revenue out of your clients. What do you think about it, Nick?
I felt the same. And I have listened to that previous episode 100 before. And yeah, United Capital, fantastic. I think when you sell to Goldman Sachs, part of you dies inside. I really do think that. He referenced Ken Fisher as someone he idolizes. Well, not idolizes, but he respects. And I'm sorry, that is an immediate red flag. It just seemed about our USP is we can flog special investments because we've got the Goldman Sachs weight behind us. I thought, oh my God, is that? And I could feel Michael Kitts is a very polite host. I could feel him wincing. I some of the answers I could feel Michael Kitts is wincing. So that's it. But it's, well, listen, the guy's story, his career story is very interesting. Guys, we're at the hour mark. I'm channeling our inner Michael Kitts. In the show notes, I've got a line saying, and be sure to listen to the end when nothing much happens. And this is the end of our episode. So I think on that note, we'll say goodbye. Andy, you're poised, or are you done, sir?
Done.
Okay, guys,
See,
love you.
You're
loads.
right. Nothing much happens at this part.
Nothing much happens. Take
Bye-bye.
care.